Okay, starting off with machinery and equipment. So with machinery and equipment, I like to tell my class that it is everything it costs to buy the equipment or machinery, get it to you, and working properly. All right, so if you're buying a big piece of machinery, or really any size piece of machinery or equipment, not only do you have to pay for not only does the cost include the actual purchase price of the machinery or equipment, but it also includes any sales taxes that might be on that equipment. All right, any freight that might be on that equipment. Now think about that. If you're buying a machine for $100,000, but you have to pay for it to get delivered to you, well, that's also going to be a cost that gets added into the cost of the equipment. Installation. What if you have to pay for it to get installed and into location? All right, any sort of fees for that would be added to the cost of the equipment. If you're buying equipment that's used, you might have to pay for some repairs on the equipment. You might have to recondition the equipment if it needs overhauling in some way. If you pay an insurance while the equipment is in transit, if you're paying $100,000 for a piece of equipment, you might want to insure it if it's coming to you. Assembly, which is kind of similar to installation, but assembly, putting the equipment together. Modification, all right, testing for use. This is kind of an interesting, well, and permits, but testing for use is what I want to spend a minute on. Now let's say you're putting a piece of machinery in your building, and the machinery needs to be tested, run, calibrated, tested again, recalibrated, and calibration basically means that you need to configure it. All right, so I joke with my class that I have a donut machine, all right, and the machine is making donuts. Well, the very first time the machine gets installed, it is not going to spit out perfect donuts, right? There's going to be some error in there. It needs to be fixed. Dials need to be turned. Knobs need to be turned. Okay, to make the machine spit out perfect donuts, it may take a few times before the donuts come out perfectly. Now, any of those costs get added into the cost of the equipment. Okay, so the cost of the wasted donut material, all right, all of that dough that's there for testing, all of those things are going to be added into the cost of equipment. Now I joke about being donuts, and of course dough is probably not that expensive, but if you were maybe doing a machine that's creating something that is more expensive, all of those test runs, all of that wasted product, all of those things get added into the cost of the machinery and equipment. Okay, and there's one other category here, land improvement. Now the thing about land improvement is it's not land itself, but it's things you might do to the land that would be depreciable. And what I mean by that is, I mentioned before that land is the only thing that is not depreciated. Well, everything else that we've talked about, buildings, machinery, equipment, land improvement, all of these items are depreciable. And that makes complete sense. You know, a fence doesn't last forever. That's a depreciable item. Over time, it's going to lose its value. Any outdoor lighting, that's depreciable. And any paved parking areas, over time, they lose their value. All right, so all those things qualify under land improvement, which is a depreciable category. Now, the one thing that is arguable here, trees and shrubs, maybe you want to think more like landscaping over time, bushes die and all of that kind of good stuff, so that could fall in there. But you can kind of argue for the other way, that how is a tree depreciable? How does it lose value over time? Well, I tend to agree with that, but I'm not the one who always I'm not the one, unfortunately, who makes up all these rules. So I like to think of trees and shrubs more in a landscaping context, because landscaping does lose its value over time. Okay, now there are some costs that may come across that are not included in adding to the cost of these assets. So there are things that could happen while you're buying your building, or building your building, or installing your machinery and equipment, and these things would not be included in the cost of those items. Now I kind of think of these almost like as whoops types of items, all right, or acts of God, things like that, things that you couldn't possibly add to the cost of the equipment because they're not things that would make sense. If somebody came in, let's look at the first one, vandalism. If somebody came in and spray painted all of your, some of your new building, that shouldn't get added to the cost of the building, because that's vandalism. That's nothing anybody can control. All right, mistakes in installation. What if you were supposed to knock down a wall in order to get a piece of machinery installed? That would be totally okay. that would actually get included in the cost of the machinery. If you had to knock down a wall in order to get a machine in, that would be part of the installation costs. What if you knock down the wrong wall? Well, if you knock down the wrong wall, that would be a mistake. And if that's kind of more of a whoops or an act of God kind of thing, then that is not going to get added into the cost of the asset. Uninsured theft. Okay, if somebody steals from you, again, not something, along the lines of vandalism, not something you can control, that does not get added to the cost of the asset. Damage during unpacking and installing, oh well, again. And fines for not obtaining proper permits. Again, these things are not added into the cost. Another thing, if there's a windstorm or something like that, and it ripped apart your building, again, these are things that are not going to get added into the cost of the assets. Okay, moving right along. Let's talk about revenue expenditures versus capital expenditures. Revenue expenditures are traditionally items that you use or expenses that you would have in order to maintain your asset. So you can almost think of it as routine or necessary expenditures. So I like to use a car as an example. A revenue expenditure on a car would be maybe getting an oil change, all right, or a tune-up. All right, they're routine, necessary maintenance types of expenditures. And they're called revenue expenditures because they are related to your income statement, right, with the word revenue in there, because they are just expenses of the period. So if you have, if you have to get your car worked on, then that would just be a debit to maintenance expense and a credit to cash. Or if you have to have a routine repair, debit to repair expense, credit to cash. All right. As far as capital expenditures are those expenditures whether you're buying something new, so it's a new capital item, and remember capitalizing, all those things mean asset, all right, basically. When you say it's a capital improvement, it's an asset improvement. So if it's capital expenditure, it is an increase to an existing asset. So for example, let's say you have a florist and you need to get flowers I can't think. All right, let's say you do have that donut place. Let's say that you need to get your donuts to the supermarkets as fast as you possibly can because they sell better when they're warm, right? I would buy a warm donut over a cold donut any day. So so in order to get the donuts there faster, you decide you're going to put a Corvette engine in your delivery van. If that were the case, then that would be an improvement to your delivery van, to your asset of a delivery van. So that cost of that Corvette engine would be a capital expenditure. All right, it improves the value of the asset. All right, so here's a little flow chart here. Revenue expenditures, normal and ordinary routine and maintenance expenses, capital expenditures if you're buying something new, you're improving something, or you're making a significant repair to it. So let's see what that looks like for journal entries. What that looks like for journal entries is if, in this example, on April 9th, the firm paid $300 for a tune-up of a delivery truck. All right, clearly the tune-up of a delivery truck is going to be routine and necessary expense. So there's your debit to repair or maintenance expense and a credit to cash. And it's a revenue expenditure. You've got a capital expenditure. You've got a $5,500 hydraulic lift installed on a delivery truck. All right, a $5,500 hydraulic lift is probably going to be bettering your asset of the delivery truck. So with that, what you're doing is you're taking that $5,500 expense and you're going to increase the value of the delivery truck by that $5,500 because you have improved it. Therefore, it is a capital expenditure. You're making that expense, that $5,500 that you just spent, you're making it an asset. You're capitalizing it. And there's your credit to cash of $5,500. Okay, nice little flow chart. I have it here for you guys, and you can look at as much as you like or as little as you like, but it's just basically a flow chart of the things we've just talked about. All right. Now, as far as leases go, your book goes into leases quite a bit. I only really want you to understand the difference between a capital lease and an operating lease. I don't think that the tests for whether something is a capital lease versus an operating lease are really relevant in this class. It's something that's more for an intermediate accounting class. So I just want to talk about the two of them and that they exist. All right. If you are engaged in a capital lease, it is almost as if you are buying the product that you are leasing. All right, and like I said, there's some tests. It has to pass certain tests before it is qualified as a capital lease, but I don't really want to get into that the numbers on the test. So a capital lease, though, if you engage in a capital lease, it's accounted for as if you've basically purchased the asset. All right? So even though it's a lease and it's not really a purchase of an asset, so let's say it's a piece of equipment, all right? If it's a piece of equipment and we are going to lease that equipment, but we're going to really use it for almost its entire useful life. We've paid for a ton of this equipment. We're not going to give it back at the end of the lease term. For all intents and purposes, even though it's being called a lease, it's almost as if we're buying the asset that we're leasing. So this equipment, if this is the case, then we are engaged in a capital lease. This equipment is going to go as an asset on our balance sheet, and we're going to depreciate it because for all intents and purposes, it's really our asset. All right. This is different than an operating lease. An operating lease means you're only using something for a period of time, and you're returning the product back to the person you're leasing it from. All right, so an operating lease, I like to think of, let's say you're renting a store in a mall. All right, now, is that store ever yours if you're renting the store in the mall? No. Are you going to give back the store the same way it was when your lease is done? Yeah. So the chances are good that if you're renting a store in like a mall, that's going to be an operating lease. All right, it is never going to be your asset, that store that you're renting in the mall. All right, it's never going to be your asset. It is never going to be on your balance sheet, and you're never going to be responsible for depreciating it. Okay, that's really the main difference, is whether or not it gets concluded on your balance sheet and whether or not you're depreciating the asset. All right.